The average American saves between 6 and 8% of their income every month and has an average savings balance of between $25,000 and $40,000 US dollars. However, only 15% of Americans invest in the US stock market, meaning that 85% of Americans keep their savings as cash in a bank account. Now, the reason this concerns me is because the CPI, or Consumer Price Index, just released the inflation numbers, and they said that for the year ending March 2022, inflation was 8.5%, which is the most rapid inflation growth we've seen since 1981. What this means is that your money today has less purchasing power than it did a year ago. For example, last year $1,000 could have bought you 76 bowls of Chipotle. However, this year, that same $1,000 could only buy you 65 bowls of Chipotle. That's a lot of guac. And if that guac is as important to you as it is to me, you do not want inflation cannibalizing it. So today I want to walk you through one of the best ways that you can invest to offset the effects of inflation. It's a super easy method called dollar cost averaging. I'm going to explain it to you so that you understand it. I'm going to show you how you can set it up and automate it so that you never have to think about it again. And then one day, several months down the line, when you open up that forgotten about brokerage account, you're going to see a surprisingly large amount of money. If that sounds good to you, let's get into it. Dollar cost averaging is an investment methodology that has been promoted by some of the greats such as Warren Buffett and Charlie Munger. And it's a very simple process to understand. Okay, so dollar cost averaging is an approach to investment where you set a specific dollar amount that you're happy to invest and a given time interval that you commit to investing to, and do that in the same stock over time. For example, let's say you decided that you were happy to invest $500 every single month. And then let's say you found a stock for $50 that you really wanted to invest in. Well, in month one, you're gonna put $500 into that stock worth $50, meaning you're gonna be able to buy 10 shares of that stock. Now let's say in month two that stock drops to $25 a share. Well, you're probably gonna be pretty upset because you're going to see your initial investment of $500 fall to $250, but you shouldn't be upset. And that's because the stock that you bought last week for $50 a share is essentially the exact same stock, but now it's half price. So instead of buying 10 shares, you're going to be able to buy 20 shares with your $500. Now let's say in month three that stock rebounds back up to its initial price of $50. Well, you're going to be very happy, but in a bittersweet way. The reason I say that is because you will have recuperated the funds from month one that initially went down in month two. Also, the month two funds that you originally bought at $25 per share, they have now doubled, so that $500 investment has become $1,000. But in month three, you might have a little bit of bitterness, and that's because just 1 month prior, you bought 20 shares at $25, and now those same shares are back at $50, meaning you can only buy 10. However, this is the dollar cost averaging approach to investing. When the prices are low, you're going to buy more of that stock simply because you're fixing the dollar amount that you're putting in. That means that when the stock goes up, you're going to end up buying less. In other words, you buy more of the stock when it's less expensive and less of the stock when it's more expensive. But what does this look like in reality? Well, one study found that had you invested $500 per month starting January 2000 and stopped investing $500 a month in December 2018, you would have invested around $108,000. But your total portfolio at the end of that time period would be $301,000. This means that you would have invested $108,000 and gained $193,000 for that total of $301,000. And it's important to remember what happened during this time period. For example, there were presidents on both sides of the aisle, a stock market bubble that popped, a global financial crisis, terrorist attacks all over the world, and an international war. However, despite all of those things, at the end of it all, you still would have had $301,000 sitting in your brokerage account. So let's take a look at how easy this is for you to set up. You could even start today. I'm going to use Robinhood, not because I'm sponsored by them, but because I think they have the easiest user interface to use, and they also have a promotion, and I'll put the link in the description, where if you sign up with them, they give you money to invest so that you can start your investing journey. So once you have downloaded the app and made an account, you can go into the app and search for a stock like SPY. I like SPY because when you buy that one stock, it's like buying the 500 largest stocks in the US economy. I'm gonna click trade down the bottom right, and I'm gonna click buy. Now when I do this, I can see that up the top right, it's saying, do you want to buy in dollars or do you wanna buy in shares? Now, because we're doing dollar cost averaging, we're fixing the amount of dollars. So we're gonna buy in dollars. But you can also see here it says conditional offers, and it says recurring investment, which is what we wanna do. So I'm gonna click on recurring investment. I'm going to say that every market day I want to put in a given amount of money. So I'm going to click continue on that. Then it's going to bring me to a page where it's going to ask me how much I want to invest at this daily frequency. I'm going to choose $100, I'm going to click review, and then I'm going to swipe up, and it is as easy as that. Now, every single day, or about 20 days of the month, because the stock market is not open on the weekends, $100 will come out of my bank account and go into the Robinhood app and specifically buy the SPY. And it's that simple. I've set it up in a way where I never need to think about it again. I can walk away for 2 months and go on holidays, and $100 will go into the SPY, it will follow the stock market, and in the next 18 years, I will likely see a similar return to the one that I showed you in the study before. I hope this video is helpful and motivates you to become a part of the 15% of people that invest in the stock market and step away from the 85%. If you have any questions, leave them in the comments. I will get back to you. Get your free stock with Robinhood, M1 Finance, or Webull in the descriptions below. Otherwise, have a great day.